And the big question is the asset class something that that still maybe outside of a couple of funds that are ultra focused has something to offer to the world? How have you kind of seen the development in these market cycles historically? Is this a good time to invest in venture, a bad time to invest in venture, just based on the research that you've done?
I'd say we're just getting into a period when it might be the right time. Clearly, it wasn't the right time at the peak. And then it takes a while to adjust. So 2022, not great. And, who knows whether the adjustment is completed by the end of 23, beginning of 24. But, wherever the trough is, that's where you ideally want to be investing. And so I feel like people who put money into a new fund now, which is going to make commitments over the next 12 to 24 months, that's pretty good timing.
Sebastian, can you talk a little bit about, I mean, your research basically starts with Fairchild Semiconductor and goes almost fund by fund all the way to present day. Can you talk a little bit about how the asset class has evolved from maybe those early days into the modern times?
Well, one important strand in the book is that, back in the 60s when the asset class began, the Series A investor, Arthur Rock, expected to get 45% of the equity in a startup when he backed it. And then in the 70s, there was more capital available, so the investors competed and the valuations went up a bit. And so the investor expected to get 1/3 of the equity. By the time Google raised money in 1998, it went down to 25%. Then by the time Facebook raised money in 2004, it had gone down to 12.5%. So you see this secular decline in the share of the equity taken at Series A by the VCs. And commensurately with that, you have an increase in the power of the entrepreneur. And I think there's a couple of things going on here. One is the copious supply of capital. Another is the rise of software, which is capital light. You don't need so much capital, so the entrepreneur gets to raise less of it and therefore keep more of the shares for himself or herself. But that's, I think, one big theme. And one question is, as we pivot back towards more hardware in defense tech, in EV batteries and what have you, will that increased capital intensivity be mirrored by an increase in the power of the VCs vis-a-vis the entrepreneur?
Yeah, that's a really interesting angle, very interesting perspective. Have you noticed along those lines? Have you noticed that sort of maybe the makeup of the types of investors have changed over time? From the early days of hardware versus software to now, it's a much more mature asset class.
What I do think is that the space is becoming more specialized. More and more venture is being allocated, and therefore it's a competitive, crowded field, and therefore it subdivides into fields where new entrants say, if you're doing a certain thing, I focus on that very thing, so come to me and I will be value add. And so I think what you see is people who really understand, defense tech, or really understand how to bridge between Israel and the US ecosystem, or what have you.
On the topic of sort of that history, I'm curious of all of the people you've researched or interacted with from that history, do you have a favorite or one who you think, man, they really thought about this game in a way that was just so much better than everybody else?
Outside of J2 Ventures, I should note, Sebastian, I know that was your tongue, so I just wanted to remove that from the option pool.
Thank you, Alex. So, the partnership that I ended up writing about the most, Sequoia, partly because they are the most successful, and I write a lot about them because I do think that they've thought about how you do this business in a more strategic way. And so if you look at the way Michael Moritz in particular led the firm from the mid-90s through about 2010, thinking about, okay, let's diversify geographically, go into China, go into India, thinking about, okay, we'll have a growth business, we'll try public equities, we'll have an internal, endowment, come kind of full spread tech investment experts. That's just, he built a firm more deliberately than most. I think most venture partnerships tend to be an agglomeration of individuals who are focused on the next startup that they're going to back. Mike stepped back and sort of thought in big picture terms about the industry.
Can you comment, Sebastian, in just meeting all of these partnerships, what are the qualities that you've seen consistently that allow people to make teams like that? Maybe you could make the argument that another Sequoia will never come around, but at least something that's a very credible competitor to Sequoia in the asset class, that you would attribute their success to the partnership itself.
Yeah, because I think your way you frame the question is important and should be underscored. I mean, one can talk about what makes a great individual investor. And there I would actually say it's sort of embeddedness in a relevant tech ecosystem. That's the single most important differentiator. Like, you need deal flow and you need to know enough and know enough people in that space to be value add. But if you're talking about a partnership, which I think actually is the right focus, because one of the learnings I had from 5 years of research is that the team aspect of venture is super important, more, I think, than in hedge funds, which I also wrote a book about. But in hedge funds, you can have an individual who comes up with a conviction about a market and just puts the trade on. Venture is more about, because there's no quantitative guidelines in early stage investing, it's very subjective. And I think in that environment, it's super important for good GPs to have fellow GPs in the partnership that they can bounce ideas off and stress test their hypothesis about something. And I think in this team building, what matters is to be quite deliberate about how you develop talent and promote it and the terms on which you bring it into the partnership, because venture is a sort of weird specialty, and people come at it with various advantages. Some have been founders, they have that operating experience, some have been to business schools, some have been to trained as engineers. All of this is good, but ultimately pulling the trigger on a deal and then having the stick-to-itiveness and the kind of emotional resilience to go through the inevitable J curve. When you make an investment, it's going to go badly at first, as the problems always emerge before the success does. Riding through that stressful time, side by side with the founder and exuding the right amount of confidence, as well as holding them to account and making them be the best version of themselves. I think all of that is a sort of craft, a human intelligence, emotional intelligence sort of thing. And I think you have to nurture people into that. And that's, again, something that Sequoia did very deliberately. Mike Moritz would sit down with somebody and say, okay, let me look at your calendar. Okay, how did you allocate your time the last 2 weeks? Let's see if we could have rationalized some choices. Some things could have been a phone call, not a meeting. And that level of micromanaging or micro-advising of a young investor, speaks to the care taken to develop talent.